What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Block, ticker SQ. This stock is down about 25% in the last year. It's had some volatility, reaching points up to $88 a share, but it looks like we're at about the one-year low right now. If we look at the last 5 years, this stock is pretty much trading at where it was 5 or 6 years ago. And then in 2021, we had quite a jump up to over $270 a share. So, and this was a company I owned back in the day during the Cathie Wood era, right here in 2021. I bought this stock somewhere in the middle here, probably, who knows, 150, 200, something like that. And I ended up having to sell for a pretty big loss. But actually, the stock is further down now than it was back then. So I saved myself a little bit of money. But this company they pretty much own a financial ecosystem of different apps, products, and services. Cash App being one of the most famous. So that's something we're going to look into in a little bit. But first thing we're going to look at is their revenue. And their revenue is kind of been stagnant the last 2 years. We're looking at $17 billion the last 2 years. And before that, though, the revenue growth was, of course, very strong, growing at an average of over 50% per year. So that's very impressive. I'm going to give that a check, even though the last couple of years have been a little bit weak. Let's see what analysts have them doing for the following year. We're looking at 22% growth this year and then 13% growth only next year. So definitely slowing down. Then we get into net income. If we look at net income, we're going to see that it's really not that great either. Negative income last year. We did have a couple years of positive net income, but it's only been getting worse ever since 2019. So not a lot of consistency there. That's not very good. I'm going to give that a no. As for the price to earnings, well, it's not profitable, so we can't really use that metric, but we will use the price to sales. And on a price to sales basis, this is the cheapest the company has been trading. We're looking at a price to sales of only 1.6. Now, keep in mind, a price when it was priced at 13 times sales, that was extremely over the top and not normal. That was not a healthy valuation. But somewhere around, as long as it's a growing company that, if they were doing 50% growth, then it would make sense to price them at 8 times sales or something like that. But with this 13 to 20% growth range, we're looking at, I mean, it could probably be priced higher than a 2 times price to sales, but this is definitely, it looks a lot healthier than it used to. So that will get a check just because it's pretty much trading at the cheapest it's been. I would consider this company innovative. We're going to look at the Cash App here. If we look at the top finance apps, Cash App is number 1. And I can't remember exactly how many users they have. I want to say it's like over 80 million. But if you aren't familiar with the Hindenburg report that came out a while back, that kind of went through all the different things about Square that they said either were just made the company look bad, or they said the executives were lying. The executives were there's a lot of share dilution, so it looked like they were kind of just taking money from investors almost. There's a lot of things they were just associated with in a bad way. They were saying how people were like faking identities through some of their apps, and a lot of the users on the app were fake, or they made duplicate accounts, stuff like that. So that's something to look into if you really want to know some of the maybe possible downsides of this company. Look at the Hindenburg report for Square or Block. Strong market share, yes. I would say not only is Cash App number 1, but then you also have all the different devices, right? The things that can process credit cards, all those different products. Those are pretty popular today. So I would say that's also a significant market share for that too. Return on invested capital, negative. So that's going to get a no. Equity is growing. This one is quite a jump. And I think it's because they acquired one of those, what's it called? Afterpay or pay later companies. So you're going to see for the years prior to 2022, it was going up, but not this sort of giant jump. 1.7 billion, 2.6, 3.3. Then in 2022, I believe they acquired Afterpay, I think, and that's how it probably jumped up to 17 billion. And now we're looking still at about 17 billion. So that's good. That's a lot of equity for a company that is trading at a $32 billion market cap. That's pretty good. So that will get a check. Is it over 15% of the market cap? Well, it's roughly half of the market cap. It's actually more than half. But the problem is, since they acquired that company, that those assets are goodwill. That's 13.8 billion in goodwill. And this is why this could be very deceptive, because that number is that can change in one day, and that number could be cut down 50%, 70%, whatever it is. That's just telling you how much the brand value is worth of the company they acquired, pretty much. So that's why I put, is it over 15% of the market cap without goodwill? And it's not, because if you take off 13-14 billion dollars from their 17, well, now we're only looking at 4 billion, right? $3 or $4 billion, and that's not 15%. So you just got to factor things like that in. Share count decrease? No, of course not. This was one of the downsides to this company. We're looking at about 8%. And in the last 2 years, in the last 1 to 2 years, it's actually been increasing even more. So, 8 or 9%, that's not a great sign. I mean, that doesn't mean it's not the end of the world. It's not something where I wouldn't buy the stock just for that reason, but it's not helping. It's definitely not helping. The assets are not 2x the liabilities, but I mean, they are, but only if you count goodwill, which again, I don't like to do that. I wouldn't, if it can achieve these things without counting goodwill, then you're really in a good and safe position. But I do not want to rely on goodwill as the majority of the assets. I just think it's a bad idea, and I've seen it backfire a lot. Teladoc Health is a great example of a company that backfired with. You could even look at like Salesforce. Salesforce acquired, what's the company? I forgot what it's called. Slack. It acquired Slack, and I think they paid $26 billion for it. So you just got to look at things like that, see how much the company is buying other companies out for, and just keep in mind that tangible assets are probably a safer bet than intangible assets like goodwill, and that number can drop pretty quickly. Profit margin over 10%? No. Cash and receivables? Yes, we're looking at what? 13 billion in cash and receivables. Income is pretty much zero. We can look at, like, let's see, what are they doing for the last couple of quarters? I believe, yeah. Well, it's still the last couple of quarters are still negative. They're doing over 5 billion of revenue in a quarter, but they're losing 100 million. So they still got things to fix there. No dividend. The company is how old? 14 years. Free cash flow? No, definitely not growing. Well, here, this is actually a beautiful example. I'm so glad I could finally show something like this. Here's the free cash flow. Okay. Now, is there several years where the free cash flow is increasing? Yes. But the problem with that is if we adjust it with that share dilution, the stock-based compensation, then many of these years turn negative and the trend is not there anymore. So that's something you have to watch out for. And that's why it's important to pay attention to how many shares are they issuing and things like that. So all in all, I'm still not interested in buying the stock yet, but I definitely will say it's in a better place with the price to sales being that low. I just need to see them turn profitable. Once they turn profitable, then it would be interesting. Other than that, I'm not interested in buying it at this time. Thank you for watching.